Hey, Denver, Chris Lopez here, and today's podcast is another podcast in our portfolio analysis series. Now, you've probably heard myself and a lot of our guests on the show have a very common goal of getting to $10,000 a month in net operating income. And this is a goal we set often as we are sitting down with our clients and talking about what their goals are, what their strategies are, because it's very hard to go out and put a plan together until we know what you want to work towards. And I'd say 80%, if not more people, that $10,000 a month is the goal that people go towards. It might be because they hear it on the podcast, or it's a nice round number, or it's a good chunk of money. But today's guest actually has a portfolio he started building just over 10 years ago, and he's pretty much achieved those numbers. Before I introduce him, I got Chelsea Scott. Chelsea, good afternoon.
Hey, Chris, how's it going?
Really good. I'm awesome. Excited to do this podcast, but this one would be really cool because it just happened that as you were going through talking with clients and starting to pull some people's portfolios out to do some analyses, this one just fit the mark so well for what our clients want. And then very fortunately, the client and now our guest was willing to come on and be an open book. So we have Travis Sperr. Travis, how are you?
I'm great. Thanks for having me today, Chris. It's exciting to be with you and have watched how you've grown this podcast and your business over the time. So appreciate you having me.
Thank you. I think you're on podcasts 20 or 15
real
years
early
ago.
on, me and Charles in the conference room with his laptop, before all of this fancy stuff you have going here. So,
and that's actually a great starting point to talk about your story. Because for those who don't know Travis is a very successful real estate investor. He's also a lender over at Pine Financial doing hard money loans for investors. But you got started by house hacking 11 years ago?
Yeah, right about then. It was in 2010 we bought, my wife and I, then girlfriend, bought a 3-unit in Aurora. It was a HUD property, did the 203K, which is for those who aren't familiar, it's the loan where you can borrow the purchase price and the rehab money. And in today's market, you're not seeing that happen. One, because there's no HUD houses, but two, because who would accept that type of financing? It's slow to close and there's a lot of caveats. So we bought this 3-unit in Aurora with the intent of living in one unit and renting the others. We bought it, did about $30,000 in work. I did a lot of the work myself. I grew up around construction, working with my father. And it was exciting. We lived there for about the year that was required. And then from there, we actually moved to another property to rent because my wife was working in Boulder at the time. We wanted to get a little closer to that. And from there, just started kind of doing the Burr strategy before it was called the Burr strategy, and buying properties really as quickly as we could. The market was much different at that time, right? In 2010, you could buy stuff off the MLS relatively easy, but times were also different in that financing was more expensive. A lot of people weren't lending money, and it was difficult to get deals done from that aspect. So the pricing was there, but it was a little bit more challenging to borrow money, and we just continued to buy properties.
Do you remember what your interest rate was on the triplex?
Oh gosh, it was probably in the 4s because it was an FHA loan, probably a heavy fee up front for the PMI. And then a couple years in, when as the market started to recover, I did a streamline refinance actually with Joe Massey. And a wild deal. As long as you were making your payments on time, you could drop your rate to whatever. And I think we're locked in now at 3.625 or something like that. And that was in 2012 or 13. So the property continues to cash flow really well.
Okay, so you bought the first property, the triplex house hack in 2010, lived there, fixed it up, moved out, and you really focused then on just buying rentals for the Burr strategy. And then fast forwarding to today, approximately what's your portfolio look like?
So overall, there's 15 properties now, with 2 that we bought that we're going to use for Airbnb, and I think we'll touch a little bit more on that. But just focusing on the portfolio that got us to this number that everybody kind of achieves of the $10,000 a month, it's 11 properties but 13 doors. So the 3-unit plus another 10 properties.
Okay, so all single families except for the triplex?
A few. So the triplex, and then I have 6 or 7 single families, and then I started buying townhomes out in Green Valley Ranch, and I've got 4 out there.
Okay, great. And then I know you were one of the first clients / guinea pigs that came through the portfolio analysis when we were really getting it figured out late last year, Chelsea. Yep. Walk us through when you started plugging in Travis's properties to your spreadsheet. Give us an overview about what you plugged in and kind of like some high level takeaways from your perspective.
Yeah, so clearly Travis had started in kind of the unicorn time, right? So he was able to capitalize on some of those great pricings that you saw in 2010, probably until about 2015 even. Some of the properties you were purchasing, you were getting some numbers like $95,000 for properties,
Sure.
which was incredible. But as you mentioned, when you looked at some of the interest rates, some were in the fives, some were in the low sixes. So a little bit different with some of the financing options at that time too. So that really stood out on the initial to go through a portfolio with somebody who had started in that initial period. And then once we put all of the properties in, I started to realize that he's already cash flowing at a really significant rate. And I think it was around $50,000 to $60,000 of cash flow before you picked up these two recent properties in 2021. So it was a pretty high number. And then I also, had really taken a look at his equity position, and that is just really strong. So, with having your 15 doors and your 13 properties, at this point, you're looking at well over a $3 million equity position sitting in this portfolio. And so it's a really nice spread of what he's done over time. And the greatest thing that I can tell you that's a takeaway for everybody listening today is the consistency at which you purchased. I mean, there really wasn't a gap in time over the past 11 years where you kind of slowed down. And so, clearly you're being on the financing side of things and understanding the lending. You probably did some really neat stuff to get there, but it was that whole rolling process where you just kept the momentum going. So that was a really big takeaway for me there. And also you've increased rents over time, which I really noticed, especially as we started to dig a little bit further into your newer properties and we revisited the properties that we initially put in. You'd increase those properties just in a 6-month period between the first and the second time I'd spoken with you. We recommend people increase 3% per year on their rents, and they should anticipate a 2% increase in operating expenses, which is going on right now with some current assessments on taxes mostly. But we tell people to expect that, and you've really helped to push the needle there as well. And I don't know if you want to speak to that or how your tenants have taken that or how you kind of approach it, but I think that's really a great part of the strategy that we encourage.
Yeah, so probably the thing that I'm worst at in managing the portfolio is increasing rents. In Denver, the rents have gone up. There was a period there where they were going up 12% per year, and capitalized over about 3 or 4 year period. It's like a 50% increase in rents, and that's difficult to do when you have tenants who have been there long term. I've got one tenant on a property in Aurora, is the second property I bought, and she's been there since day one, so over 10 years now. And she's Section 8, so it's a little easier to raise the rent on that. But I do have some properties in Montbello that are probably $400-ish per month under rented. And it pains me to say that out loud, but the fact is when rents were going up quickly, I couldn't keep up. But then the second piece is I didn't want turnovers, right? Because a turnover, especially now as materials and everything are more expensive, is probably going to be, for people who have been there for that long, I don't know, $12,000, $15,000. So at some point you have to look at, okay, if I could squeeze another $300 a month, how many years to break even? And so I do have some properties that are under rented. Now, here's the problem when you get to a portfolio this size and being under rented. If you've got 2 or 3 properties and you're under rented, you'll make it work. But if you've got 5 properties that are under rented by $400 a month, that's $2,000 a month, right? Over the course of a year is $24,000 a year, which would probably just about cover my kids' daycare costs annually. But it doesn't cost you any more to operate those properties. And that's one thing where I have done okay at, but going back, if I could have done better, I would have been much more consistent with even if it was a 3% bump or a $50 or $100 bump on these properties to make sure that in X number of years you're at market. If you have a property now that the market should be, say, $2,200 a month and you're at $1,700, it's very difficult to capture that. You can continue to increase each year, even with aggressive pushes, but it's going to be really difficult to get to that market rent.
Yeah, and I mean, I can see that. I can see that in some of your properties as well. I did notice though in that 6 months, you just made some minor increases. So that alone though can be helpful. Just that people know that you can just ask for that, that small increase. And at least in the Denver metro, understanding the concerns of not wanting the turnover, we do have a market that is, just booming with renters. And so people can understand that inventory issue. Some people do. And so that can be helpful to raising the rents as well. No doubt. But yeah. So those were some outliers.
So I got some questions if you're, since you're an open book,
Sure.
Travis. I'm really curious because, we spend so much time on this podcast talking about, acquiring properties, building it. We won't spend much time talking about that because, you've talked about it and now you're in a position where you have some options with your portfolio. Actually, can I have the mouse back, Chelsea?
Yeah, sure.
So, looking at your current property right now, you have about $4 million in total value and just about $3 million in equity. And looking at a lot of these properties, your current cap rate, which is, the current valuation, the current NOI divided by the current valuation, not the purchase stuff from the last couple of years, but if you bought it today or sold today, what would the cap rate be? You have a lot of cap rates that are 2-3%. I mean, sub 4, most are sub 4, a couple are sub 5. Now, when you see those, a lot of times you have options there to, hey, should I pay off the property? Should I cash out refi, or should I sell?
Sure.
And usually when cap rates are that low, it's usually the best use of equity to go out there and sell 1031 and trade up, which I've learned that from Lon Welsh and
Sure.
the way, his matching numbers, hey, if it's below 4% cap rate, probably time to sell and trade up. So what are you doing with these properties? Are you going to refinance? Are you going to pay off? Are you going to sell and trade up? Because I want to know what you want to do, because I want to be in your shoes in a couple of years.
Sure. So this is difficult. If you measured my portfolio from a return on equity, it's terrible. There's no question, right? From a percentage standpoint. But I remember having a conversation years ago with Charles Roberts when I was just about to buy another rental. And I said, hey, I don't know, Charles. At that point, I've got $1 million in debt. Granted, it was all relatively low leverage on good real estate and cash flowing. And his comment to me was that the spreadsheet every single time is going to tell you to buy more properties, leverage them, because you're going to participate from the appreciation. You're going to benefit from the depreciation, and of course from the principal pay down as you own the property. But your gut is going to tell you something different, right? Because everybody has a certain level of debt that maybe they're willing to take on, and from a portfolio standpoint. So my goal, I remember we were on our honeymoon, my wife and I, and we were in Costa Rica, and we were driving across the country, and I was sitting in the front and she was sitting in the back. And I was just scribbling on a piece of paper trying to decide, how do we get to a point where this money is passive and we can live well and not have any worries. And at that time, I think I was targeting 15 properties and at that time, $1,200 a month in rent, right? And so, and then if you get them to free and clear, what does that deliver? And I was good with that number, but as life changes and costs of daycare and living and different things, the goal changed. And so the goal now, which is actually outlined in the your book that you'll launch in a few weeks, is to get to $1,000 a day, so $30,000 a month in income. I know this is a long answer to what you're asking, but I think it'll help to back into it. So my thought now is if we can get to 20 properties free and clear by the time I'm 50, which is another 13-ish years, then 20 properties at $2,000 a month is $40,000. At 25% expense, that's $30,000 or $1,000 a day. That's where I'm working toward. I can't get to that number and can't have free and clear properties if I'm continuing to refinance, trade, and move up. I can likely get to the income required. But another thing that I think about with single family houses is they're so easy to buy, they're so relatively easy to manage, and they're really easy to liquidate. So I could trade up to, say, an apartment building, but if time comes where I need to get some money out, I could maybe refinance it depending on the market conditions. I could sell it depending on the market conditions. Who buys an apartment building? An investor. What do investors want? Deals, right? So with a single family house, at any point in time, I could peel one of these off and decide I'm going to sell this and buy 2 more. I could sell this and pay for college. I could sell this and blow the money. You can kind of do whatever you want. So that's what has kept me from leveraging up to continue to buy properties. Now, we've been very fortunate to have good incomes and cash flow from these properties where we can continue to buy properties without having to do that. But I can't get to my goal of paying off the properties if I'm continuing to finance them.
Yeah. And so one thing I want to highlight there is, to your point, Chris, I mean, people focus on cap rate a lot, right? It's one of the number one indicators that people may use to make a decision on a property.
Sure.
And what I really like here is that you're helping to explain that it's not all about the cap rate, because your goals are different. You have this cash flow and NOI goal, and to get there, you don't see it as I need to sell or trade or leverage a property. in order to move that cap rate, you're more concerned about that $1,000 a day. So that can also apply when somebody's buying a property. So if they're buying a property and the cap rate looks low, but they see it as something that they can then use for the future, or it has another reason why that particular area may be appreciating at a really rapid rate. And it might be right in the curve where it's just on an upward trajectory. And so they're capturing it at some point on that upward slope. And when they get it, they're like, well, I know it's going to appreciate another 100,000. So the cap rate's not great right now, but I'm going to count on the fact that more people want to rent here and it's going to continue to appreciate. And so those can be other reasons to look at a property, especially in a market like this when cap rates are so compressed.
Yeah, and I love that you guys use cap rates, because 5 or 6 years ago, we weren't looking at cap rates when looking at value in single family rentals. We were looking for what is the gross cash flow or what's the net cash flow, and what is it going to look like over time. It's good to use the cap rates because it gives a really easy way to measure across all asset types how the asset measures, right? So if you know you're out there getting a 7 cap on true numbers, you know you're getting a good deal. Where we used to just look at it as, gosh, you're doing the BRRRR strategy, you have as little down as possible. I'm going to cash flow $500 a month. I might get all the money I have into this back in 12 or 18 months. So the deals were a little different. We didn't even look at cap rates. It was all cash flow driven. Now, of course, today, as more real estate and had you guys teach to look at cap rates, it does help to give a better setting across the whole portfolio. But just as you alluded to, it doesn't necessarily take into account the cash flow. I mean, it does that from return on investment, but one thing I like to say is, like, especially with equity, like, you can't buy beer with equity, you can buy it with cash flow. And so it's kind of similar with cap rate, right? Like you, although it does drive the income, cash flow at the end of the day is what's most important.
So I got a follow-up question on this topic, because in my mind, it's always looked like, for example, I'm just going to this first property, which is just property 1 in here. We took out the addresses, but you've got a bought for $95,000, $300,000 equity, and your loan balance on here is 0, right?
Yeah, he paid that one
Okay.
off.
So a property like this, where it's a 2.5 cap rate. So a property that you would never buy today, because it's just, it's very poor performing, but it's a great cash flowing property. Why would you not just sell that, take all the equity, go out there and put that, take $350,000 of down payment to go out there and buy 4 single family rentals to get to the goal faster, higher NOI? I'm just curious, like, why your mind looks at it differently.
2 things on this property. I think that this one, this is on East 52nd. This is in Montbello. So this property is rented for, I think now, $1,650 a month. The market rate's significantly higher than that. So this is one that I'm just behind on. So actually, it would be a lot easier for me to get a better rate on return to just give them either a really high increase or notice to non-renew, and then rehab it and go back and probably get, if it's rehab, maybe $2,200-$2,400 a month, shooting from the hip a little bit. So I could increase that return on investment significantly. But to your specific question about sell this property, maybe even go do an exchange and buy 4 more, that's kind of where the spreadsheet says you should do that every time, because you will have 4 properties. So now instead of having 380, maybe you have $1 million in real estate. So if it goes up by 10% a year, which we don't count on forever, but has been typical lately, now you're gaining $100,000 a year instead of $38,000 in this example. That's a great question. My biggest reason was to keep the debt relatively limited, and I've had the ability to do that through some low purchase prices. So let's say you did sell this property and go buy 4. I mean, I've just bought 2 properties in the last couple of months. It's difficult out there, So then do I have to go look to a different market? I know this house really well. It's probably a conservative approach, and would likely, if I buy more properties, gets me to a higher cash flow, but it'll also take longer to, when I pivot to roll all the cash flow in to pay down the properties, that it would extend the timeline just that much further.
But you did mention you want to attempt to get to 20 properties eventually, right?
Right.
So that's still the goal. So you could still use this as a refinance.
For sure.
If you don't want to sell it, you could refinance it, and then you could use that cash too.
Right. Now, I've identified 2 properties in the portfolio that I'll probably sell next spring. And this is going to sound crazy, but mostly just because the landscaping is so difficult on them. They're just like, it's like a sand yard. And
wait, that's a bad thing to have
yeah, right.
Yeah.
But just an opportunity to get rid of some portfolio or some dogs in the portfolio, right? And we use these times when real estate is really valuable and it's going up at a good run to kind of sell some of those. And I will most definitely 1031 exchange out of those, but I don't know what I'll get into at this point. And maybe it's you sell 1 and buy 2 with heavy down payment or something like that. But all in all, I want to make sure that when I get to 50, that I have the ability to have these properties free and clear. And my biggest concern in ratcheting up the debt is that I have to ride that longer. Of course, that gives me an opportunity to potentially sell those when I get to that time and use the money to reduce debt on others. But that's what's great about this game, right? Is that you can literally skin this cat so many different ways. And whether that's through more properties or more cash flow or lower debt or more debt or whatever it is, there's a lot of ways to be successful in this business.
And this is, like I said, I appreciate you saying that, Travis, because you did a great job of saying, hey, the spreadsheet says to do this, but I'm not because of this, because you have your own investing parameters, your own risk tolerance, and your overall portfolio LTV. And that's something every investor has to figure out for themselves.
For sure.
As you said, we can all get to the same destination, but if you plug in Google Maps, we're each going to have 3 different routes to get there. Same thing with this property. So this portfolio. So it's great to know what's best to do, but you have to then take that and give it the context. Hey, what are your goals? What's the current market conditions? What's your risk tolerance? What's all this other stuff going on? And it's great that you're able to articulate that, because I feel like that's something a lot of times people aren't able to, or they take it for granted. So I want to really highlight that for our listeners out there, as to the way Travis is analyzing it and saying, you know what, this is what I should do in a spreadsheet, but here's what I'm doing and here's why.
Sure.
And you can...
Yeah, it's such a great point, Chris. And something I was thinking during that as well is that's part of why we set up goals in the analysis, in the sessions that we run. So we set up this goal set to say, how much equity would you like to actually see? Now, we don't have your goals in this spreadsheet, Travis, because I just pulled your actuals. We didn't actually set up goals. You were already on your goal path when we met. And so, I set up your goals of how much do you want in NOI? How much do you want in cash flow? How much equity do you want? And then we have to kind of move the pieces around to try to meet those goals. And they don't always fit the traditional advice. They don't always fit what people may think. And then we start to shift things around to hit where they want to be, because your goal is $1,000 a week. And so how do we get to that 360 basically, in there? And I had a question for you too. Of all your properties you've had, minus the 2 you just recently acquired, have any of them had any long extended periods of vacancy in the time you've held them?
No. And I mean,
at
all. You're right.
And that's great. And I'll tell you why I'm asking that, because you had mentioned, maybe you want to look to another market for properties, which we see a lot here, people looking to Colorado Springs and looking maybe up north and looking to other places outside of the metro. But one thing that we've heard over and over in real estate investing in Denver is that we did not experience the same kind of attrition in this market during those bad years. And I get you were on the tail end, you were just on the recovery period,
right?
But we are continually seeing so much immigration, so many people moving here from different places. We've seen it during COVID. I think we're on the top 10 list of some publication of one of the top 10 places people are moving during COVID. And so, that really just highlights that you as an investor over almost moving on to 11 years now have seen really consistent occupancy rates. And I really love that, because it speaks to, it's like firsthand experience speaking to what we say is, Denver continues to be just a really robust, strong market for rentals. And we just see more and more evidence of how that's continuing. So
yeah, I mean, I can
great.
think of off the top of my head a handful, maybe 5 properties that I own that have the same tenants that moved in on day one. Now, maybe it's obvious because the rents aren't as high as they should be, right? Yeah. But it's wild when you move someone into a property. That one on 52nd we were just discussing. The same tenants have been in there since 2012. The property I bought in late 2010, same tenant the entire time. Which is great because turnovers cost money, and when you go back and look at what this individual and or Section 8 or whoever has paid you over that time period, it is wild to think about the amount of money that you brought in from these properties.
Yep.
And they're paying your mortgage.
Yeah, and then some. Exactly.
Yeah. So that's been great. 2021, you want to talk a little bit about the 2 you just picked up?
Yeah.
I'm going to scroll. Or Chris, can we scroll over?
I'll give you back the mouse.
Thank you very much.
So the 2 properties I just bought we'll have to do a kind of a little bit of some assumptions, kind of as we discussed. So when we got into 2021, so I came out of a pretty sizable new construction project that we sold in December. And the goal was, same thing in a spreadsheet. We sat down and said, okay, here's going to be the proceeds from this project. What are we going to do with it? We're going to pay some properties off. We're going to do this, just these different things my wife and I worked through. And so going into 2021, I said, okay, we're going to buy 3 properties this year. And, with about 200-ish thousand, maybe a little bit more to put toward that. And I was talking with Joe in detail, and he's like, look, man, if you don't care about the cash flow, which you've said you don't, then why buy 2? Buy 3 with 15% down. I was like, okay. So he got my wheels turning. I get a property under contract at $400,000 in Thornton, decent little deal, 4-bedroom, 2-bath, a big garage. And the first time I've ever paid for a home inspection, we in 11 years. And I'm thinking, well, if we're paying this much for a house, maybe we should get a home inspection. So the home inspector is walking through the house, and he kind of questions my, did you smell something on the way in? And they're kind of talking about it. He said, maybe it was meth or something. I thought, oh, that's kind of weird. So we got home, we slept on it, and we said, let's just get a meth test. Big deal, right? Sure enough, that thing was hot, right? Wow. I mean, like, I think it's actually a survey. So if it's 0.05 or higher, then it's considered hot. The report came in at the first test was at 400, and the second one was in the 200s.
Wow.
Yeah. So dodged a huge bullet on that. And that was at the time where I was like, okay, we're going to buy this property. We're probably not going to cash flow, especially with 15% down, but this is going to feed the overall picture of getting into 20 properties, let the rest of the property hedge, right? In some ways, it's like dollar cost averaging, right? I'm still putting money in the stock market today in my retirement account at the all-time high. Similar with real estate, right? You're going to continue to buy properties in order to hit your goal. You can't just stop and say, well, I'm going to wait till later. So with the idea of, okay, I don't know if we're going to actually make any money on this, but we're going to buy it. I was getting a little discouraged, and I met someone who was doing Airbnbs, and I thought, wow, this is interesting. But in my initial conversation, I said, look, I'm not going to be a good host. If the cleaners don't show up, somebody will have a really bad stay. I just want to be clear. I'm not driving across town to clean this. And if I have the wrong attitude, just tell me now and we'll stop the conversation. And she said, no, let me show you how to do this a little bit more automated. Let me show you how to put the right systems in place. So we bought 2 houses that we'll use for Airbnb. One of them we launched just a couple weeks ago. And so with some broad assumptions, we can get into the numbers, but that we would net $2,000 a month over the mortgage as a return from these. And so the way I've always done things is, well, why buy one and make $24,000 if we could buy 2 and make almost $50,000 a year? Let's go for it. So we bought 2. We just launched the first one, and it is incredible to me what people will pay to stay in these properties. Yep. This is kind of in the northwest side of Denver or the metro, and we're getting $400 a night in July. So we launched this mid-April, and in the next 10 or 12 weeks, we've got over $11,000 in bookings on this Airbnb.
That's amazing.
And so this is brand new to us, yep. Right? So the idea was, that's kind of where the numbers come in on this, is the idea is that we would net $2,000 a month. So we would need to make about $5,500, $6,000 in gross, minus the fees and the consumables and the cleanings and that type of stuff. We should be able to net $2,000 a month per property, where it might have been we might have broke even otherwise on a traditional rental.
And you were able to systematize the process. So you're able to automate you have everything turnkey now. You have it ready to turn over when somebody leaves, and that's not something you have to manage.
Yeah. So the agreement with my wife and I was that I would handle the vendors and she would handle the guests. So she owns a business, a couple of franchise locations, so she works from home. And the idea was, well, could you manage the guests if I manage the vendors? And the crazy me, I always go sign us up for something and come home and say, good news, right? We're going to do Airbnb. She's like, we're going to do what? and I had always been so resistant to it because it seems so management intensive. But with the right tools, you can make it, and we're still early on. So, ask me in 6 months or a year from now.
Right. No, but it's a great starting point. And I just want to point out that, you paid around $490,000 for each of these properties, right? Which is a great price for somewhere that can pull in $6,000 a month on average, as just, kind of what you're estimating, maybe $5,000 a month. But even if you didn't get to $5,000 a month and you were at $4,000 a month, or maybe even $3,000, you're at least going to get close to break even most months, and then making a profit other months. So if you don't hit your $24,000 a year, it still looks like it has a lot of room for cushion for those bad months should they happen. So those are, in my opinion, in this market in Denver, to buy 2 of those in 2021, find them, get them under contract, that's a huge win.
Yeah.
So would you factor in the Airbnb income is obviously higher than long-term rental income and more management intensive. With your $1,000 a day paid off goal, would you factor in the higher Airbnb income in towards that $1,000 a day goal for your retirement purposes?
No, everything for the long term is based on that, which is light, $2,000 a month on 20 properties for a couple reasons. One, regulation could change the game overnight, right? If these areas decide that they're going to be regulated, and at that point in time, the properties would do okay with long-term rentals. I wouldn't have bought them as a long-term rental if that was the sole purpose, but if it takes 2 years from now and rents continue to climb, it would probably do better. Or I could sell it at that time, assuming the market continues to perform the way it does, cash out, 1031 exchange, go do something different. But I think that, and I bought these properties in March. I closed in March and April. So that was kind of just before things got really crazy. And one of them, we can talk a bit about this too, when we offered $70,000 over. So they'll work in the long term, but in the short term, we're going to squeeze as much money as we can on this short-term rental. And as long as it'll work, we'll do it. And if at some point we decide we just absolutely dislike it, or there's regulation, then we'll just move on.
Okay.
Yeah. And I like that plan B a lot because I think that way as well. So we have 2 different kind of VRBO Airbnb properties, and I look at the plan B. Like, could I sell this as a single family home to a family? Is it in a neighborhood where there's a family? Also, could I potentially rent it just to a long-term renter? Like, what would happen if regulation did change? And so, I mean, it's great to have purchased those thinking about that, right? With that in mind.
So a while back, you mentioned this is a great time to sell, your dog properties. So I want to ask you about that because, you've been in the business now for a solid decade, buying properties, helping people put together deals on the hard money side. And I talk to, a couple clients a month. They, hey, they bought their first property of a property, and it's a dog of a property. It's been horrible, or they hate it, or whatever reason. What is your recommendation in general to investors out there in market conditions like this? What do you do with those dog properties?
Yeah, and I suppose everybody would describe a dog differently. My goal so a while back, I did a reverse 1031 exchange and sold at that time what was the dog in my portfolio and bought 2 townhomes.
Can I ask you why that was your dog in your portfolio?
Yeah, so that property, it was in Montbello, got a good price on it, had good rent for the numbers. The challenge was that it was a 2-bedroom, 2-bath, 2-car garage. It was basically a glorified apartment on a single family lot, right? So it was difficult from a value standpoint to capture the rent I needed to justify owning it because it was only 2 bedrooms, where everything in the area is 4 bedrooms. And so that property, I thought, well, gosh, I don't know how long I want to own this. So we sold it. And then I used that as in a reverse exchange to buy 2 townhomes. So kind of back to your question about the dog properties, keeping in mind everybody describes the dog differently, you have to decide what are you going to do with the money. So often we say, oh, this property's going to give me a hard time. And your dog property this is why you need spreadsheets like this, because your dog property in your mind is the one you take the most calls on, but you may have another property where you never hear from the tenant, but it's not very profitable. Or your dog property might be the one that's on a busy street or has that terrible lot or whatever it is. I do think you should sell those properties if they're causing you trouble, you don't want to own it any longer, but what are you going to do with the money? So that's where you may look at doing an exchange. You may look at paying the taxes on it, depending on your income situation. I mean, we're at a point now where I would never sell a property just because by the time you pay all of the taxes along the way, you'd be better off owning the property or doing an exchange. And if you've had trouble, depending on where your trouble is, keeping tenants, maintenance, whatever it is, trade into something that's not going to give you that problem. So when I sold that single family to buy townhomes, I'm like, oh, this is beautiful. No yards, no exterior maintenance, right? Like the trash is taken care of. It's just so much easier to manage. Of course, you pay an HOA that captures some of that, but the purchase prices we got were really good. And it gives us an opportunity to continue to collect cash flow. So if you do it right, I think you would do the same or better. But even if you did a little worse on a monthly basis, if it's less of a headache for you and maybe even a newer property, I think you'd do better to sell the properties.
So for people out there in a situation, sounds like step one is really define what a dog property means to every individual.
Sure.
And then really take a look at the numbers and take the emotion out of there, but really put some context to it and weigh like, hey, here are the numbers and here's the headache or here's the downside, right?
Yeah, that's exactly right. And then maybe the next step from there is to identify what you're going to do with that. Because in this market in Denver, it's so difficult to find a deal. But let's remember, if you're doing an exchange on a property you bought 10 years ago, you captured so much appreciation that you haven't been able to do anything with. Keep that in the back of your mind and go buy a deal that doesn't make as much sense maybe from a cash flow standpoint or what you're paying for it. But if it's going to take some headache away and now you've traded so much equity into it or over multiple properties and it's getting you towards your goal, then you should definitely do that. But don't get excited to sell it and then go try to find something and then only buy the next property because you don't want to pay the taxes on the previous sale.
So let's talk about the reverse 1031 because, for listeners who aren't familiar with 1031 exchanges, it's a way to really basically defer capital gains. And they come with some stipulations that, that property you sold in Montbello, Travis, the day it closes, you have 45 days to identify your new property or properties, and then 180 days from that closing to close on those properties. So there are timelines. And so many things along the way can blow it up. And us being in a very tight seller's market make 1031s more stressful now. A reverse 1031 helps mitigate a lot of those timelines because you basically buy your replacement property first, then sell your existing or relinquished property. So walk us through what you did and how you made it all work, because there's higher fees and there's definitely some more moving parts.
Yeah, so a lot of moving parts, and this is fun because I learned this strategy at one of our success summits. I'm sitting in there listening to Tracy Wilson, and he's talking about reverse exchanges, and I'm taking notes like crazy. I've never even heard of this before. And I thought, gosh, I have a property I'd like to sell. And so the way I was able to do it was I identified the property I wanted to sell. Now, you mentioned they're more expensive. So there's a couple of ways you can do a reverse exchange. If you've got a bunch of money, you can go out and just buy the other property for cash, as long as your intermediary is included so that you title it correctly. And then you could just sell the other one and it's relatively inexpensive. But the way that I wanted to do it was pretty specific in that I actually change the title in the relinquished property to the 1031 intermediary. So now they're on title. The reason you need to do that is because you're going to buy your replacement properties in the name of the entity that you had it in previously. And so it's kind of in the weeds, but
so that's your LLC or
that's
whatever.
correct.
Right? Okay.
Yeah, or your personal name if you are holding your properties that way. So now I need to go buy properties in my LLC that I've been running my business in. So what I did was I used a combination of things, actually. I had a line of credit available that I used that on one of them. So the first one I bought, I used Pine Financial Group. It was a good deal. I was able to put a good amount down because I knew I was going to have this money coming from the 1031 exchange. So I used my line of credit to put the money down, made some repairs to it, and then did a refinance on it. The second property was actually in good shape. It was right off the MLS. So it was one of those like, hey, we'll close next week type of deals. And I actually worked with First Bank on the purchase using, again, the line of credit as a down payment on that. And then when I sold the relinquished property, then we were able to roll the funds. So what I did was went out and bought two properties, identified and bought two properties. After I already had those purchased, then I actually got the tenants out of the existing property, cleaned it up, and went on the market to sell it. The biggest benefit in the reverse exchange is the timing, as you mentioned. So where traditionally you'd have 45 days to identify and 6 months to close, on the reverse exchange, you have 6 months to sell the relinquished property from the time you purchase the first replacement property. So you have significantly more time.
So no 45-day window, then just have to sell within that 6-month period.
And do you remember, I think you mentioned something about a fee, right? Like a $4,000 fee.
Yeah. So
how you're able to recoup that.
Yeah. So the fee is hefty on a traditional exchange is probably still under $1,000, a forward exchange. Reverse exchange, on the specific way I wanted to do it, where we title the relinquished property to the intermediary, was $4,000. So it's a lot of dough, right? It's a big fee. But at one point, I was collecting rent on 3 properties. So it was pretty easy to offset that cost.
So great. Because of that 6-month period you had.
Exactly.
Right.
Exactly. And so it makes it, it's complicated and it's more expensive, but it just paid dividends in this scenario. I mean, we did so well on the resale of that relinquished property, and the replacement properties did done really well.
Yeah, and it's great because we have some clients that are looking into 1031s. A couple we're working with right now, and we have absolutely recommended the reverse because it's not just the fee that, while it seems hefty, and you're not just, you were able to recover yours, but you also are saving yourself all the stress and headache of that 45-day, 180-day period that is so tight in this market. And so the ability to do this and actually take that pressure off, I think for decision-making purposes and to keep your head on straight, during the whole process is just, it's invaluable.
Yeah, 100%. Yeah. When you get to a certain point in your career, money solves all problems, right? And so the difference of a $3,000 fee is peanuts compared to, even if it's just the stress. I've got 3 young kids. I'm not out looking at properties on Saturday morning. We're going to soccer and swim class. So the ability to do things kind of at your own pace is definitely so valuable, especially over that $3,000.
Yeah, I totally hear you.
So this is something, because I know you've got a very unique perspective, both being an investor and also a very active lender as well. For people, a lot of people are like the 1031s, but they run into issues where they don't have the funds to go buy their replacement property first. Do you have any ideas or recommendations for financing options, or does Pine offer like financing options so people can basically get a bridge loan or a loan to help them buy that first property, then sell the other property?
Sure. So it's not like in our at Pine Financial, it's not like in our on our list of loans that we offer, but we take a common sense approach to everything. So if you had a property that you had a bunch of equity in, and then you wanted to buy another one, we would certainly look at the ability to bridge that for you. You could tie up the equity in the first property and then use that more or less to reduce the loan balance when when you sell that property on the second property. So you could certainly do it that way. That's the other thing about the reverse that can be challenging. Another thing you could do is get a line of credit on your relinquished property first, if it's a high equity position, and then use that money to use as a downstroke on the new property. You will want to be a little conscious in how you communicate that, because most banks may not want to do a line of credit if it's not going to be out for a long time. So you definitely would want to work through that. So you could accomplish it through private or hard money, a line of credit, or if you were pretty liquid, I guess you could handle it that way. So there's some different options. And you've really just got to figure them all out, right? Because this business revolves around financing, and understanding financing is what really helps people be successful.
Yep. Is the most underappreciated step in every purchase 100%. Is the financing.
Absolutely.
And so, it's paperwork, it's a headache, but it is so underappreciated as financing. So I'm going to jump around some other questions here. Looking back at your portfolio here, Travis, you bought 2 new properties in 2021 so far, but you also paid down a couple properties as well, right?
Correct.
So how do you decide which properties to pay down? Like, how do you look at the chessboard and decide to pay off these 2 while you're buying these two new properties?
Yeah, I wish I could tell you there was like some really methodical process in identifying these properties. It really came down to, I had a handful of properties that are really low loan balance. And my wife, she owns her own business, and we're all 50-50 in all the rental properties. So she has a good income from that. But she's a little unsure on how long she might run that business. And so the idea was, let's pay off the ones that are in her name to drastically reduce the DTI so that we can continue to buy properties in her name. If at some point she decides that they don't want to operate this business anymore, they want to sell it, she could be without income, right? Or as much income as she has today. So the goal now is anything we buy to finance it in her name, if we're going conventional, the bank typically requires us both to sign, so that we can use as much of her, 10 property max as possible. And then when the time comes where we hit that, or she does something different, then we would kind of transition over to my 10 properties, if you will, looking at conventional only. I do have a handful of bank loans, and banks do a great job too, but the best long-term, low-rate financing you can get is still Fannie and Freddie. So we try to do that as much as possible. I do have a handful of 15-year loans from First Bank that worked really well because they were non-warrantable condos or townhomes at the time. The other thing is both properties were with the same loan servicer. And so it was like, if we're going to knock this one off, let's just be done with them, right? And move on to something else. And so that's what's a little challenging about my goal of getting to the 20 properties, is that I have to both pay them off and continue to purchase, which kind of pulls you in 2 separate ways.
Yeah.
But what's wild is you pay off a property and the cash flow on day one on those increases $750 a month. Now that's not all, wasn't all interest, but you do have to look at the money you're getting from principal pay down, because now that's in your pocket instead of paid down on your loan. And then of course you need to prepare for your escrows, taxes, and insurance.
Yeah.
That's very insightful.
It is. And one thing is, so clients ask us, or have asked me in a session, so we suddenly have X amount of dollars, that's called $250,000, and we want to start paying down properties. How would you approach this? And so my general response is, I like to pay down newer debt versus older debt first, because your newer debt, you're paying a lot more interest right now than you are principal. Whereas older debt, if you've had a place for 5 or 10 years, you're in a place where you may be paying, potentially depending on the note size, you may be paying more principal than interest. And so that's one thing that, I've had the conversation about. The second is spreading it over multiple properties based on what the cash flow comes out to look like right at the end, if that's the goal. And like we said earlier, what the spreadsheet tells you or what the traditional advice is doesn't always fit people's life circumstances. Sure. So what is that goal? Is it more cash flow? Is it getting rid of high interest payments? Because oftentimes people think real estate debt is good debt, and it is. It's asset-backed debt. So, you have something to back up that debt as opposed to credit card debt or a depreciating asset like a car. So I'm just curious on your take, if it wasn't for your wife's circumstance, if you were just basically to be, to look at your portfolio and say, I have $500,000 right now, what would you do if you were going to throw it at this spreadsheet?
Yeah. So one thing I would encourage people not to do is to spread it across multiple properties, especially in a case where you had 250 or 500, depending on your total debt size, because your payment stays the same. Unless you make a significant pay down, you can recast your mortgage. So what some people aren't familiar with is, let's say you had a $200,000 loan and you threw $100,000 at it. Now you've got a $100,000 loan balance. You can call the servicer and do a recast. And basically what that does is take that $100,000 and spreads it over the term of the loan. That's how you'll save money in your monthly pay. If your goal is really to pay them down over time, you may not do that because it would really accelerate your principal pay down by making a big payment like that. But I would try to pay off a full property if possible, because It will help with the DTI standpoint. And when we look at debt, it's funny to think about paying off high rate debt. I've got mortgages I think are still 5.5, maybe 5.75, but the loan balances are so small, $60,000, $70,000. The fixed fees in a refinance they don't make sense to do it, even if you could drop 2 points in rate, unless you were going to take cash out and do something different with it. So I would try to focus on a property you could pay off completely. But of course, before you were going to pay off a property, you need to identify what your long-term goal is. And if it's to buy 3 more rentals, you'd be better to buy them now than 2 years from now, right? So it's another thing you have to identify. It's T. Harv Eker, right? Don't wait to buy real estate, buy real estate and wait. We've seen that just in this year in this market, right? At the rate that properties are going up. So if you were going to say buy another property next year, do it now instead of paying them down. If you've gotten to a point where you say, okay, we're in a good place, we hit our 100,000 a year or whatever the goal might be, or we're unsure what the future brings and we're going to pay them down, I would try to do full pay downs. Newer debt or older debt, I totally respect the idea there of you're getting more principal pay down as you get through the amortization schedule. Higher rates, all the rates are so low right now that maybe that doesn't matter as much. So you might either go for the lowest balance or the highest rate, probably.
Yeah, that's great. No, I appreciate it. And the recast is a great tip.
Sure.
That's a great suggestion.
Have you actually recast loans?
I haven't because I haven't made heavy principal payments other than just paying them off completely. But I've certainly considered it on that triplex that I have. I actually put a significant payment on it to save on the PMI because from a cash on cash standpoint, it was actually really strong to just make the payment down. So there's just some different ways. And, there's so much math involved in this business. You can't make a bad decision, but you should make the best decision, right? Yeah. And if that means increasing cash flow via recast or a full pay down or something like that, then you should certainly decide what's going to work best for you.
Yep.
You're at basically with these 2 new Airbnbs, assuming they perform out like you're expecting them to, you're basically about 240,000 NOI, which is 2/3 of that goal of 360, which is $30,000 a day, or $30,000 a month, $1,000 a day. So for this last third of your portfolio, what's the broad strategy getting there as you're buying properties and you're paying them off? Like, what do you prioritize, and what's the last, part of the marathon for you?
Yeah, so great question, and something I think about a lot. I mean, I've wrote it down. I've entered spreadsheets. In fact, I wasn't going to buy anything that was old. I was only going to buy properties that were built in the 2000s and newer or whatever it is, so that the maintenance would be easier and they'd be easier to manage and that type of stuff. But when I shifted to the Airbnb strictly to capture as much cash flow as possible, I was buying houses that were built in the 60s and 70s, just the fact of the way it is, right? So going forward, I think that we'll continue to probably see, here's the benefit of what we've done so far is that we don't have to race now, right? I mean, we are kind of cruising in the way that if we can buy one property a year or even one every other year for the rest of the term and use the cash flow that's coming in to pay it down or use that as a downstroke, we'll still get there. So the priority, how to prioritize it, we're done this year. I can tell you that. And here's why. The Airbnb, it's been really fun and we've had it was exciting getting it launched and all of that, but it's a lot of work. I mean, traditionally I bought a property, put a for rent sign in the yard, filled it, got the cash flow and moved on.
And you self-manage too.
All except for my 3 unit. Yeah. And I'm actually moving towards management. We can talk a little bit about that too. But on the Airbnb, it was like, let's squeeze as much as we can. But here I find myself renting a Home Depot truck to go pick up this couch because it's a really good deal, and it is not the best use of my time, but it's kind of exciting. And anytime something's kind of fun, you get that focus. And now I'm shopping Facebook Marketplace and there's a button where you can see how much to have it delivered from Dolly, right? And I'm like, yeah, all day long because it's going to cost me
they have that feature now?
Yeah, it's wild. So you find a couch in Broomfield, okay, we'll put in your zip code and it'll automatically integrate Dolly. Dolly's an app that you can use to basically get stuff moved. And I used it a couple years ago. We bought something. My wife loves Craigslist. I mean, she's always finding a deal. So that part's exciting. But but then what does that mean? Travis has got to go get the U-Haul and do this and that, deliver it, get my car. So Dolly now, and most moves across the metro is about $100, and then you can tip them. And so I've started moving toward that. And so it's like, although sometimes like $100 to move this thing, you know what? I don't have a truck. I don't want to bug my friend for a truck. And now I don't have to go rent it. So the Airbnbs, they were intensive to get set up. And so we'll get these. The one is launched. The second one we hope to have launched soon. And we'll operate those this year and then probably focus on paying off maybe 1 or 2 more properties by the end of the year just to continue to keep it all moving forward. Going forward over the next handful of years, what we buy, I thought my focus was going to be on newer stuff. I was even looking at some new construction stuff out near the airport. It's crazy what the prices still were. Now, this is a couple months ago before apparently there's no 2x4s left that aren't $12 each. So the prices on that stuff's going to continue to go up, but it's wild what you can still see. And historically, cities grow toward the airport. They move the airport way out there, and at the time seemed so far away. And even when I bought those first properties in First Creek, it was like, wow, this is way out here. I just drove out there the other day. I don't visit my properties often, but I went out to one, and I'm like, oh my gosh, I didn't even recognize it. Every bare field's got earth movers in it. They're building like crazy, and the prices are still relatively affordable, even for rental properties. And what a lot of people may not understand is, although you may not want to live in Green Valley Ranch, the rents are still strong out there, especially if you want to go Section 8. And I've got a good portion of portfolio at Section 8. And so you could still capture good cash flows out there. I know a lot of what you guys are doing with some of your clients on the house hacking is renting by the room, which is super intriguing to me. At my old age and 3 kids, no way. But what a wild way to get going, something we hadn't considered previously.
Yeah, the cash flow in the room by rooms are phenomenal, but it's a lot more work, and it's usually for the single younger people that are willing to do that. So as we kind of wrap up this interview, Travis, I want to get your perspective. You're 11 years into a great career, both as an investor, as a hard money lender. You talk to clients all day long. You're buying your properties still. You're optimizing your portfolio. And people say, is this a good time to buy? I feel like I've missed the wave on Denver real estate. I feel like I've missed the wave in real estate investing in general. What would be your advice either to a new person, or if there was the 25-year-old Travis today and you had the fortune to give yourself advice today for starting out, what advice would you give people in terms of like what to do tactically and just some good advice on some context for the market and big picture?
Sure. So the short answer is the only property I've ever regretted was the ones I didn't buy. There's some small misses in the past, right? 10 years ago, I don't want to put that much down on this property, and then look what happened. Let me give you.
Do those still haunt you?
I wouldn't say haunt, but
bug you maybe, bug you a little bit,
because there was 2 houses on the same street I passed on because I had to put down, I don't know, remember what it was at the time, $15,000 each or something using the Burr strategy versus today those properties are 6x that price. Let me give you a little background on what I've done over the last 10 years to kind of give an idea of exactly what my mindset was. So I started buying in 2010, started getting heavy, 11, 12, up into 13. 13, I bought this property in Southwest Denver, and the appraisal came back at 180, and I couldn't believe it. There's no way this 900 square foot house is worth 180,000. There's no way this can continue. This is nuts. This is bananas. So I actually pivoted at that point in 2013 and started doing new construction townhomes. So I bought my first lot in 13, delivered the units in 15. After the proceeds from that, I used that to buy another lot in West Colfax. I built 8 units there, did really well on that, and then parlayed that into the project that I mentioned previously that I sold this past December. So I actually kind of shifted focus and started doing new construction because the payouts were so big. But along the way, I would still just buy a property here or there. And what I've kind of regret is I thoroughly enjoyed the new construction, and we did really well at it. It was a great way to get big chunks of money in relatively short periods of time. But what I did miss was that I slowed my rental purchasing just a little bit. So from 13 to 15, I think I might have only bought one property. And then I started buying a few more. I did the reverse exchange and that. I wish I'd have been a tad bit more consistent. So coming back to, is the market overpriced? Can somebody be successful today? There's so many ways you can be creative now. We talked about the rent by the room. I mean, what a phenomenal way. And I enjoy listening to your podcast with what I'm going to call these relatively young people who are buying these houses and renting the room. And I'm just like, oh my God, I can't believe people are doing this, but it works, right? And when you look at the numbers, and that's one of the things that makes real estate investors successful, especially in rental property, is the ability to delay gratitude, right? Or
delay gratification.
Delay gratification, excuse me. So the ability to do that changes everything, because you'll meet your friends who just bought the super sick townhome downtown, and they'll say, I'm thinking about buying a rental property, but we just, put $125,000 down on this and we're a little tight, versus the person who bought that house in Aurora, who is renting it room by room and just really capturing these goals and knowing that, in the words of Dave Ramsey, live like no one else, so later you can live and give in his way like no one else. So it's really interesting. So I think that's cool. I think the buy maybe a ranch and Airbnb the basement is really interesting right now to be able to capture some of that. So although the times are different, the strategies are different.
Yeah, and I like that a lot, Travis, that creativity piece, because, for example, our property managers that work with this group and with us as investors, they saw such an attrition in downtown Denver that came in a huge wave, and rents were dropping and people were dropping and vacancies were, and people were selling. And people who grabbed those during this wave, right, are going to be happy in the long run as well. And then there are these opportunities in the affordable housing space. I mean, right now, policy, right? You talk about our Airbnb is going to go away in a certain place, right? Policies are changing and affordable housing is so needed. And when you mentioned Section 8, or you go into a pocket where there's just really, really good affordable rentals, that people can afford to buy and then renters can afford to live in, that's another great creative solution in this marketplace. And so there are some really neat ways to sort of get around this at this time. So I hear you.
Yeah. And I mean, just listening to some of the stuff you guys are doing and preaching and teaching for that matter is it's really powerful. It's just, most people are going to buy 1 to maybe 5 houses in their lifetime if they move quite a bit, versus, it's like not even, I don't want to say it's not exciting to buy houses now, but it's so commonplace. And it's kind of funny when you talk to people, whether it's a cocktail party or whatever. So what do you have a rental property? Oh, 15. It's like no big deal because we've done it. Right. And so for people who are getting started, I love going back to the data. What is it? 6% per year on average for the last 50 years in Denver.
For appreciation?
Yes, for appreciation, including the downturn. So if you could live in a property for 2 years and you can get up 12%, it's going to give you the ability to do that refinance or potentially move to the next property. And you just keep doing that. And it's what I call crock pot cooking, right? I mean, it's slow and low. It is not sexy, but damn, you get rich. You know what I mean?
Dude, that's a great metaphor.
Totally.
So I got 3 questions left for you, Travis. Are you still doing the Burr strategy? Because I get this question daily almost. Maybe not quite that much, but the Burr strategy.
So I'm not, and it's probably because I'm lazy. So is there opportunities to still do the Burr strategy? Absolutely.
What would it take, though, for someone to successfully do a Burr in today's market versus 8 years ago when you were doing them? How's that changed?
Yeah,
Burr sounds good on paper, but reality is it's tougher right now.
Yeah, so I think that when you focus on the Burr strategy, the whole idea is no money down, right? But really it's no or low money down. And low is relative in today's market, because you could go buy a property with 25% down, which is a lot of money down, or you could potentially do a Burr strategy and say you could shake it down to 6% down. That'd be that'd be a really good deal.
I would love to do that right now.
Right. So are people still doing it? It can be done, but my advice would be not, if you want to wait for the perfect Burr strategy, you might do one every 2 years, right? And you better be hustling, knocking on doors, off-market deals, that type of stuff. Or, and I actually heard you refer to this one time in one of the podcasts about how investors are sometimes buying flipped properties because everything's done. And I could buy a flipped property and put 15% down on that, of course, on that purchase price, versus digging, trying to find something, buying it, rehabbing it. And then I was running the numbers on wholesale deals left and right. And all I could find was by the time I bought it and did the work to it, I did get a equity bump, maybe somewhere between 5 to 12%, which for some people, they would kill for that. But at this point in my life, I can't manage rehabs and all of that. So I prefer just to go buy it. I look on the MLS or whatever it is, and I'll just go buy the house rather than going through the rehab process. That is still a fantastic way for people to buy real estate, to force that appreciation. But if you're gonna hold out for that, I don't know how many deals you're gonna get done.
Okay. Second question. You had mentioned this is off the cuff. The Investor Success Summit. This is an event that you, Pine Financial in Newcastle, have been hosting for, years, as long as I know. Did not happen last year because of the pandemic. Normally happens now, October-ish time frame.
Yeah.
Are you planning on doing? I'm putting you on the spot here, man. The hot seat.
You know what? 2 weeks ago, probably would have said no. I had lunch yesterday with a couple people who are involved, and the feelings were mixed. I'm ready for it, and I think the people are too ready to get back out. So my task was to go reach out to the venue and say, hey, if we want, how many people can we have? Does it need to be capped at 200? Can we go to 400? What will that look like? Based on all the things I'm seeing coming out of the governor's office, under a certain amount, I just saw something last night on the news. It seems like it's plausible, so long as the event space is okay with it. So I'm hopeful that we have the opportunity to host a Success Summit this fall.
Great. Let's talk more about that, because I agree. I'm very eager, and I think people are too. And as you know, we just scheduled our first live in-person networking event at the book launch, and we've gotten a lot of RSVPs already as of in less than 24 hours. And people are hungry for it, and Oh my gosh.
They're ready to get out, man.
Get rid of Zoom calls.
That cocktail party you mentioned, it's been a while since we've been to one of those. Yeah.
So Travis, what's the best way for people to get a hold of you, whether they want to pick your brain or, work with you on the lending side? Like, how can people reach out to you?
Sure. So you can definitely call me. It's a little bit more challenging that way. It's at 303-835-4445. That's the office line. I'll also give my email. It's Travis, Travis at Pine, like the tree, financialgroup.com. And I'm happy to help. So if somebody needs a loan, of course, I'd love to work with you. If it wasn't for people like Charles Roberts, as an example, who I had the opportunity to meet a long time ago, I don't know that I'm where I am today, right? And even working with Kevin, the founder of Pine Financial, one of the benefits of going to work with him 12 years ago now was that I was going to be sitting next to a successful real estate investor all day, right? I left my plumbing job making plumbing wholesale vendor $40,000 a year so that I could go take a chance on a commission income and learn about real estate. And at that time, I had so little to lose, right? I could go find another job doing that, no big deal. But I had this opportunity to learn. And if it wasn't for the people who helped me along the way, I wouldn't be where I am. So I'd like nothing more than to see more people be successful in this business. And it's so fun and it's exciting. And when people are really passionate about buying rental properties and collecting cash flow and doing the nomad or rent by the room or Airbnb, whatever it is, to squeeze a couple more dollars out of a piece of real estate, that is so exciting. And one thing I like to share with people that sometimes in presentations is if you think about your parents' retirement or even your grandparents' retirement, if they owned one property free and clear, how much different would their life have been? And what if they owned 2 or 3 free and clear? How much different would their retirement of their life been? And of course, maybe eventually your inheritance. So it's exciting to me because you can really change your family tree through real estate investing. And you don't have to be a genius to do it. You can literally buy new construction or homes that you're going to live in, rent the room or whatever it is, and make some sacrifices now and just crush later. And that's exciting to me.
Yeah. Like Nike, just do it. Right?
Yeah, that's right. That's right.
Just get it going.
Travis, this has been great. So all your contact details will be in the show notes, and I will iterate what you said. If you guys do reach out to Travis, be respectful of his time. I know how busy he is. So, if you come reach out to him, he's happy to talk to you, but be prepared.
For sure. Have
questions and definitely take some notes on the podcast so you're prepared for them. And also, if you guys have questions on what to do with your portfolio, reach out to us or talk with Chelsea. Hey, I might sell this property. We can help you analyze. Should you sell it, keep it, fix it up, find that sweet spot, and then put it in context with the portfolio as well. We're trying to do a better job of getting all this data, plugging the spreadsheet. And we know what the spreadsheet often says, but then giving the consultative advice, say, great, let's play some scenarios and talk about your goals, your family situation. Mm-hmm. Oh, who's on what loans? Oh, we need to strategize this, like Travis and his wife are talking about with their properties. Right. So please reach out. We love doing it. So Travis, thank you. Chelsea, thank you. This has been great.
Thanks, Chris.
Thank you.